Welcome to Breaking News to Trading Moves. Today we're looking at a major announcement in the airline industry.
We are. An acquisition that really affects the whole leisure travel space and all the companies in it.
Yeah, so we're going to get into the material around the announced acquisition of Sun Country Airlines by Allegiant Travel.
Exactly. We'll walk through the deal itself, the strategy behind it, and then, the most important part, who wins and who faces some new pressures.
Okay, let's start with the hard numbers then. This really sets the stage. We have Allegiant Travel, that's ticker ALGT,
Right.
and they've agreed to acquire Sun Country Airlines.
Ticker SNCY.
So the initial read on this, I assume, is just a pure play for scale.
It's all about scale, especially in that vacation-focused airline segment. I mean, both Allegiant and Sun Country have these unique non-hub models.
Right, they connect smaller cities to vacation spots.
Exactly. So combining them, it just instantly creates a more powerful player in that specific market.
And the financial structure, that's crucial here. It's valued at roughly $1.5 billion.
Mm-hmm. And we should probably mention that number includes Sun Country's existing debt.
That's a key detail. And it's structured as a cash and stock deal.
Yeah, which always adds another layer of complexity versus, just a pure cash transaction.
So for shareholders, what does that look like?
Sun Country shareholders are getting $4.10 in cash plus 0.1557 shares of Allegiant for every share of Sun Country that they hold.
So when you add all that up, what's the per share value?
It comes out to around $18.89 per share for SNCY.
And that works out to a pretty substantial premium.
It does. It's about 19.8% higher than where the stock closed right before the announcement.
That 19.8%, that's a powerful signal.
So, absolutely. It tells you two things. First, Allegiant really, really wanted this asset. And second, that the management is confident that the future synergies will justify paying that premium right now.
Let's talk about the timeline because it seems a bit long. They're guiding for a close in the second half of 2026.
It is long.
Why so far out? These seem like two pretty compatible airlines.
Well, that timeline is all about a huge operational and regulatory hurdle.
Okay.
Even after this deal officially closes, the two airlines are going to have to run separately at first.
Why is that?
They can't actually merge their flight operations or their booking systems or even their pilot pools until they get a joint FAA operating certificate.
And that certification process, that's known for taking a very long time in these mergers, isn't it?
It is. It's a massive undertaking. It's much more than just paperwork. The FAA requires them to harmonize every single operational and safety protocol.
So you mean things like pilot training manuals, maintenance systems?
Exactly. Two completely different maintenance systems, two safety cultures, all of it has to become one. That kind of overhaul and the regulatory scrutiny that comes with it, well, that can easily push a timeline out 2 or 3 years.
Understood. So once they finally get through all of that, what does the new combined company look like in terms of size?
The combined fleet is expected to be around 195 aircraft. And importantly, management has put out some very clear financial targets.
Which are?
They're aiming for $140 million in annual synergies. And they expect to fully realize that by year 3 of the combined operations.
That 140 million number, that's the benchmark. That's what the market is going to use to judge if this was a success.
It is.
So where do those savings come from? How do they get there?
It's from a few different places, all coming back to that idea of enhanced scale. First is just procurement leverage.
And so buying in bulk.
Buying in bulk. When you're buying fuel or parts for 195 planes instead of, say, 100, your negotiating power with suppliers just changes completely.
Makes sense.
Then you can merge expensive IT systems, especially for things like reservations and back office functions. And third, you can optimize maintenance schedules and routing, which is a major, major cost for any airline.
Okay, so let's get into the bigger strategic picture. We know it's about consolidation, but what makes Sun Country such a good fit for Allegiant, beyond just adding more planes to the fleet?
The real key is the complementarity of their geography and their fleet. Allegiant, historically, has been moving toward an all-Airbus fleet. Sun Country uses a mix of Boeing 737s. And while having different fleet types can be a bit of a headache during integration, the real value is in their networks. Allegiant is fantastic at connecting, say, a mid-sized city in the Midwest to Florida. Sun Country has a really strong footprint connecting those same regions to places further west and into Mexico.
So they're not just taking out a competitor, they're building a much more complete leisure network without having to build every single route from scratch.
That's it, exactly. They get a broader footprint that lets them move planes wherever the leisure demand is strongest, instantly. And that leads back to those two main benefits we talked about.
The cost leverage and the potential for better pricing power. On that pricing power point, though, both of these are ultra-low-cost carriers. They're known for being really competitive on price. Does removing one of them really let them just raise fares?
That's the million-dollar question. And no, they're not going to start charging legacy carrier prices overnight. That's not the model.
So what does it do?
In specific vacation corridors where they might have been the two main competitors, taking one out lets the new combined airline better manage its ticket yields and capacity.
So it's more about protecting the low fares they already have.
Exactly. It lets them protect revenue and make sure they aren't getting forced into these unprofitable fare wars with each other. It's about yield management more than it is about big fare hikes.
Okay, and this brings us to what might be the central issue for the next 2 years, the regulatory environment. We've seen government scrutiny stop other airline mergers recently.
It has.
So how does this deal become a test case?
Oh, it absolutely becomes a live examination of the current antitrust thinking. I mean, regulators have consistently brought up concerns about competition and consumer choice when they look at airline deals.
But this is a little different, isn't it? It's two leisure carriers, not a legacy airline buying a discount one.
It is different, but the sheer scale of what they've become in the ULCC space, that's going to draw a ton of attention.
So the regulators are going to be asking, does this new, bigger company become a barrier for smaller airlines trying to compete, even if they aren't directly overlapping on every single route?
That's exactly right. They're going to look at the network overlap, the pricing models, the long-term impact on consumers who really rely on those non-hub routes. The outcome here is going to send a very clear message about future consolidation in the U.S. airline market.
That sets the stage perfectly for how the market is going to react. So let's get into the trading implications. Sort out the winners and the companies facing new pressures. We'll start with the winners.
Okay, so the first category is what you could call M&A spillover. This is the idea that this deal could lead to a re-rating of other discount carriers.
And the logic here comes from that nearly 20% premium that was paid for Sun Country.
Right.
A successful deal with a premium like that, it just resets the baseline for what other low-cost airlines might be worth if someone wanted to buy them.
Correct. The market sees a high value put on one niche airline, and it immediately starts to wonder if that potential applies to other similar companies.
And the material cites 3 specific names here.
It does.
The first, obviously, is the company being acquired, Sun Country Airlines SNCY, just because of the premium being paid to its shareholders. Who else benefits from this sentiment?
Frontier Group Holdings, ticker ULCC, and Spirit Airlines, ticker FLYY.
Okay, why them specifically?
Because both are major low-cost carriers, they're actively managing their networks and costs, and they have the kind of assets, the network, the fleet scale, that could make them attractive targets down the road if this kind of consolidation continues.
Got it. Now, our second category of winners looks a little further down the stream. It focuses on beneficiaries of just more travel in general.
Yeah.
The leisure travel demand beneficiaries.
The thinking here is pretty simple. A larger combined Allegiant and Sun Country means more planes, flying more nonstop routes to more vacation destinations. All that new capacity helps drive up overall travel interest.
So when you have more people looking for flights and hotels in places like Vegas or Orlando, where do they end up booking?
They end up on the major booking platforms. So we're talking about Expedia Group, ticker EXPE, Booking Holdings, BKNG, and Airbnb, which is ABNB.
And as flight capacity goes up, they just see more traffic.
It's a direct link. They see a boost in search volume and, more importantly, in actual bookings. More flights to vacation spots means more business for them.
All right, finally for the winners, let's talk about the supply side, the physical hardware. The third category is the aerospace and engine supply chain.
This is a direct benefit of just having a bigger, more active fleet. A combined fleet of almost 200 planes operating at high frequency, well, that leads to faster wear and tear.
That means more maintenance.
More maintenance events, exactly. And that means steady, predictable revenue for the companies that supply the parts and the engines.
So who are we talking about here?
It increases demand for spares, provides good revenue visibility for the OEMs and the engine makers. So the names that come up are Boeing, BA, GE Aerospace, GE, and Helmet Aerospace, HWOM. They all stand to benefit from that sustained use.
Okay, let's flip the coin. Time to look at the companies facing some new pressures or risk factors because of this deal. First up, The immediate pressure on overlapping leisure routes.
Right. So you're creating a scaled, very disciplined ULCC. That means any competitor operating in that same price-sensitive customer segment now has to deal with a much stronger network.
The combined Allegiant and Sun Country can be more aggressive on pricing.
They can use aggressive pricing and their wider network to defend their market share.
So who feels that squeeze the most? Who flies the routes where this new company has a much deeper advantage?
The material points to three key competitors with a lot of exposure to leisure travel: Southwest Airlines, ticker LUV, JetBlue Airways, JBLU, and American Airlines, AAL.
And how does it affect each of them?
Well, for Southwest and JetBlue, they're competing directly for those same price-sensitive travelers. For American, a stronger ULCC might force them to dedicate more of their own resources just to defend their lower-cost leisure routes.
Okay, next category of pressure is focused on the buyer itself. Acquirer execution risk. We already talked about the complexity, the long timeline, the cash and stock involved.
And acquirers almost always see their stock dip right after announcing a big deal. Allegiant is no exception here. It reflects market skepticism.
Not necessarily about the strategy, but about how hard it is to pull it off.
Exactly. There's risk tied to the cash outlay, the dilution from issuing new shares, and just general doubt that those $140 million synergy targets will actually happen years from now.
And of course, the risk tied to that FAA certificate timeline we discussed.
Precisely. That long period between now and 2026 is just a period of heightened uncertainty. So the acquirer, Allegiant Travel, ALGT, lands in this column because of that immediate risk premium the market puts on its stock.
Is anyone else sensitive to this kind of execution risk?
The material also points to Alaska Air Group, ticker ALK.
Right, them.
They're mentioned because they're already navigating their own very complex integration after recent M&A. So their stock can be sensitive to any signs of trouble in other big airline integrations, as it might signal broader difficulties across the sector.
Okay, for our last category, let's go back to the regulatory side. This is the regulatory headline risk basket.
This is where market sentiment can get contagious. Any sign that the regulatory review for this deal is going to be tougher or more delayed than people expect. That can translate into immediate pressure on the whole industry, even on companies that have nothing to do with this deal.
Why would a tough review for this deal put pressure on, say, legacy carriers who aren't even merging right now?
Because it effectively puts a ceiling on their future strategic options. If the government signals that the bar for M&A approval is now extremely high, it affects how they think about using mergers to compete or expand down the line.
It makes future deals look a lot riskier.
And less likely to succeed. So the names mentioned in this risk basket are Delta Airlines, DAL, and United Airlines, UAL.
And they're included just because they're major players who have to be thinking about long-term strategy.
Right. They have to constantly evaluate all their options, including potential M&A, especially as the ULCC segment gets bigger and stronger. A tougher regulatory environment just changes their long-term math.
Well, that gives us a really solid framework of the winners and losers. As we wrap up, let's summarize the two key things for anyone to watch as the story plays out.
Okay, the first is to monitor the arbitrage opportunity. That means you're tracking the difference, the spread between the implied deal value of Sun Country, SNCY, which is that 1889 figure,
Right.
and its actual trading price on any given day.
And that spread is basically the market pricing and uncertainty, correct?
Exactly. If the spread is narrow, the market is pretty confident the deal is going through. If that spread widens, it means investors are pricing in a higher chance of regulatory problems or the deal falling apart.
And the second point to monitor.
It's the integration pricing on the acquirer. You really want to watch Allegiant stock, ALGT, over the near term.
To see how the market is weighing the pros and cons.
Precisely. It's a way to gauge how the market is balancing the risk of the cash outlay and the long timeline against the potential upside from those $140 million in synergies that are expected by 2026.
So if you're trying to grasp the broader meaning here, a final thought to consider might be, how does this aggressive move for scale by leisure-focused airlines ultimately influence the long-term strategies of the legacy carriers?
It forces them to reevaluate how they defend their own lower-cost vacation routes.
Every player has to adjust to a new, larger competitor in the space.
Yep, a bigger contender.
And before we sign off, a mandatory point. This is not financial advice.
Right.
And it's not a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the material provided.